An unstoppable shift is coming to Wall Street, but are we ready to embrace it? The financial world is buzzing. Nasdaq has officially filed to allow trading in tokenized securities. This is a seismic move that could forever alter how stocks are bought, sold, and owned. But here's where it gets controversial. While some celebrate this as the dawn of a transparent, blockchain-powered era, others worry about potential risks and market integrity. If you've ever wondered how blockchain might transform the traditional stock market, or why some experts remain deeply skeptical, read on. Breaking the news. On September 8, 2025, Nasdaq dropped a bombshell by submitting a regulatory proposal to enable tokenized securities trading. Why is this such a big deal? Galaxy Digital, a notable digital asset and infrastructure firm, recently tokenized its own Nasdaq-listed shares. And several crypto companies are rolling out tokenized versions of U.S. equities. These moves hint at a future where blockchain could become the main ledger for equity ownership and trading. Tal Cohen, Nasdaq's president, took to social media to highlight the opportunities blockchain brings: faster trade settlements, modernized proxy voting, and programmable corporate action management. Yet, he issued a crucial caveat: security, resilience, and strong governance must remain at the heart of U.S. equity markets. We're open to collaborating with new and existing trading infrastructure providers to push innovation while protecting the essential trust that defines our markets, Cohen emphasized. Chuck Mack, Nasdaq's SVP for North American markets, explained in a recent Q&A that this proposal allows trading of tokenized stocks and ETFs under existing regulations. The Depository Trust Corporation, DTC, the industry's trusted settlement agent, would process these transactions in token form. Participants could even choose if trades settle traditionally or as tokens. No difference in the execution quality, identification numbers, or shareholder rights compared to classic shares. The key point: existing U.S. market rules already allow different representations of securities. Whether you buy a regular or tokenized share, your experience as an investor remains consistent, Matt clarified. Still, the real game changer hinges on SEC approval and whether the DTCC's tech is ready for this evolution, a milestone that's likely pushed to 2026. As Security Token Markets newsletter notes, this momentum boosts confidence that the future of equity markets will be on-chain. And this is the part most people miss. The implications go far beyond speed and convenience. Daniel Shapiro of Blockworks Research points out that by enabling tokenized and regular shares to trade in the same order book, Nasdaq might end up launching its own blockchain and convincing a vast network of teens to adopt its protocols. Is that even feasible? Or will this effort fracture the trading landscape? Galaxy Digital's bold leap. Galaxy Digital recently made headlines by becoming the first Nasdaq-listed company to tokenize its SEC-registered equity directly on a public blockchain. In partnership with fintech firm Superstate, Galaxy shareholders can now hold their stock as tokens on the Solana blockchain. Their white paper boldly claims, "Tokenization will do for value what the internet did for information." Think about that. Just as the web revolutionized how we share and access knowledge, tokenization could transform asset ownership and finance. Here's where controversy flares. Not all tokenized stocks are created equal. Many tokenized offerings use synthetic or wrapped models, sometimes without issuer approval, raising questions about legal rights and real ownership. Unlike third-party wrappers, Galaxy worked directly with Superstate, an SEC-registered transfer agent. This means their tokens represent real, fully compliant shares, granting the same legal rights to token holders as to those who own traditional stock. Superstate logs legal ownership on the blockchain in real time, and peer-to-peer trading is permitted between investors who pass regulatory checks. Importantly, Galaxy's on-chain shares maintain full regulatory compliance, can potentially be traded 24/7, and feature rapid settlement. But this new market isn't as open as pure DeFi. Automated market makers, AMMs, for trading Galaxy's tokenized stock are not yet enabled due to regulatory uncertainties. As the white paper warns, there's no guarantee of on-chain liquidity until more stable and transparent secondary market venues become available. For now, trades can happen only between verified parties. Tokenization models, real shares versus wrappers. Superstate stresses that their approach stands apart from others, like Robinhood's, which often rely on synthetic representations of shares. Take Ondo Finance's recent launch, through the Ondo Foundation. They offer international investors access to over 100 tokenized U.S. stocks and ETFs on Ethereum via fully backed custodial models. While these tokens bring exposure to U.S. assets, they don't always transfer full ownership rights, highlighting a deep divide in how tokenized equities are structured. Will Peck of asset manager Wisdom Tree argues that the industry needs to rethink its approach. Tokenized securities might be wrappers tied to off-chain assets, fully on-chain shares, or even tokenized cash flows. Traditional wrappers, like ETFs, show how market participants can hold assets on one ledger even as those assets are tracked elsewhere. Tokenized securities extend that logic, but sometimes at the cost of legal rights or investor protections. Peck's warning? Just because a security is tokenized doesn't guarantee its liquidity. Secondary market rights, redemption options, and the structure of wrappers all matter. A growing divide or a new era? Security Token Markets newsletter summarizes the emerging landscape. Some tokenized shares are mirrors, others are directly tokenized, and some may lack real backing altogether. Native tokens ensure true investor rights, but mirror tokens offer simpler access for overseas investors. Each approach brings its own trade-offs. Meanwhile, Coinbase, Robinhood, and Kraken aren't sitting idle. All three are reportedly building Ethereum Layer 2 solutions to bring equities on-chain as quickly as possible. Who will win, and what system will establish itself as the standard? So what's your take? Would you trust a tokenized share over a traditional one? Is this a revolution for all, or just the next Wall Street tech fad? More importantly, will tokenization democratize finance or simply introduce new forms of risk and confusion? Let's debate. Share your thoughts in the comments below. Which approach excites or worries you most?